A very good afternoon. These are the top business stories live from the Sky newsroom. Division among policymakers as the Bank of England keeps interest rates unchanged at 4.75%. Household water bills in England and Wales to rise by an average of £31 a year over the next 5 years to help the sector pay for infrastructure upgrades. Plus, as a US consortium completes its takeover of Everton, we'll examine the agony and ecstasy of owning a Premier League team. A very good afternoon and welcome to Business Live on this Thursday with me, Darren McCaffrey. The Bank of England has kept its main interest rate unchanged at 4.75% following a meeting this morning. But policymakers have become more divided about whether rate cuts are needed to tackle a slowing economy. 3 of the bank's 9-person Monetary Policy Committee voted for a quarter-point cut, where just 1 dissenting voice had been expected. Let's get more on this with our business and economics correspondent, Gurpreet Narwan, who joins us now. A very good afternoon to you.
Good afternoon. And the Bank of England has voted to keep interest rates on hold at 4.75%. No surprises there, Darren. But what is interesting is what comes next. And I want to show you these dotted lines behind me because they show us where markets thought that interest rates, the trajectory for interest rates would be before the budget and how they changed those expectations after the budget. So as you can see, before the budget, we were expecting a much steeper fall in interest rates, that they would fall below 3.5% by 2028. And then the Chancellor unveiled her budget. There was a big increase in taxation in that budget. And all of that has changed the inflationary outlook, meaning inflation is likely to stay higher for longer. And that's been reflected in the repricing. You can see that that path is a lot shallower than we thought it would be. And all of this, it poses a challenge for the Governor and for the Bank of England, because while inflation is proving stubborn, the economy is flatlining. Andrew Bailey today said that the bank would continue to weigh the two up closely. Let's have a listen to what he had to say.
I do think that the course of interest rates, the path is downwards, but there is more uncertainty around. And so we had to weigh that up very carefully. And I think the appropriate thing to do at this meeting was to keep interest rates on hold, but we'll come back at the beginning of February for our next meeting and start it all over again and review the evidence. But I think the fact that there is a difference of view within the committee, I think, first of all, I think it underlines the strength of our process. There's no groupthink on the MPC.
So the outlook is uncertain, but where markets think the interest rate might end up is important for our mortgages today because it reflects the pricing of mortgage products. And let's have a look at where those mortgage prices are. Well, you can see in this graph behind me, the 2-year, the 5-year, how they've changed since we had the big inflationary surge and the rise in interest rates from the end of 2021. And they started broadly coming down, although there was a spike in energy prices that caused mortgage rates to peak again. But generally, throughout 2023, 2024, they have been coming down, except take a look at this bit here. This shows what happened after the budget. The 5-year and the 2-year, they increased on the back of expectations of higher inflation. They're now at about 5.3%. Now, it may not seem like a massive jump in the context of the kind of jumps that we've seen over the past couple of years. But as I said, the outlook is uncertain. We're not confident where that's going to end up.
OK, Gurpreet. And the really interesting thing today was that division, wasn't it, in the MPC, a reflection of our sluggish economic prospects?
Yeah, this is the big trade-off that policymakers have to factor in constantly, that trade-off between inflation and growth. And while there are inflationary pressures in the economy is also sluggish. Growth is flatlining, and 3 members of the MPC committee on the back of that voted to cut interest rates. We spoke to Andrew Bailey about that, asked him whether we can be confident that the bank is making the correct decision. And as you heard in that clip, he said that actually the diversity of opinion was a good thing, that there was no groupthink on the committee, but that they would continue to weigh the two up throughout the coming year.
Great stuff, Gurpreet. Thank you very much indeed, Gurpreet Narwan there, with the analysis of this decision. Let's get more now with Philip Shaw, Chief Economist at InvestTech, who joins us. Philip, very good afternoon to you. Not a surprise, but still interesting nonetheless, not least of all the kind of minutes we got access to of that meeting.
Yes, hi, good afternoon. Not a surprise at all that the bank rate was maintained at 4.75%. It wasn't surprising either that there was a split on the committee. The committee hasn't been unanimous since September 2021. What was surprising was the way that the committee was split, with 3 dissenters from the decision all wanting reductions in interest rates. And that came after a week where we've had a surprising jump in reported wage growth and also a rise in inflation as well. I think what markets had forgotten was that we've had also some very disappointing data on GDP, with the economy contracting both in September and October, and those members actually saying, do you know, over the medium term, that could actually push down on inflation and we need to cut rates now. But absolutely a very interesting set of minutes.
Not least of all, the Bank of England predicting effectively 0% growth this quarter, and also talking about the impact the budget may well have through to next year.
Well, certainly the economic numbers towards the end of 2024 have been disappointing, and we concur with the Bank of England's analysis that there probably won't be any growth in the final 3 months of this year. In terms of the budget, we hear a lot about the burden on businesses from the increases in national insurance contributions. But what's often forgotten is that the government is due to launch a big injection of cash into the economy, and that really will support growth over 2025. So there has been some talk of a very weak economy or even perhaps a recession, but that's not something that I would buy into. It does still look as if we're going to get a scenario unfolding over 2025 of moderate growth.
And just, Philip, finally on that then, what does that mean for interest rates looking into next year? The Fed yesterday suggested maybe a slower pace in terms of cuts. That's what we're looking at, do we think, here as well?
Well, the situation in the US is somewhat different, with an incoming president that may well raise tariffs and cut taxes. And that does spell caution in terms of the US central bank, the Fed, being more cautious in easing policy. Over here, I think the situation is unclear, but perhaps less so than in the States. We've got an economy that has lost a bit of momentum. If you don't believe the wage growth numbers, which the Bank of England clearly doesn't, then you could be looking at more modest inflation pressures looking through 2025. And we think it's likely that we'll probably get 4 reductions in interest rates through the course of next year, ending at 3.75%.
OK, Philip, thank you very much indeed. Philip Shaw there, joining us from central London. Now, the water regulator Ofwat has announced that household water bills in England and Wales will rise by some 36% over the next 5 years, and it means, on average, costs will go up by around 31 quid a year. That's significantly higher than those that had expected a rise of £20 per year, outlined in draft proposals in the summer, but it is less than the 40% hike water companies had asked for. The money, we're promised, will pay for substantial improvements to infrastructure and to reduce those sewage discharges. Well, here's more on this from our business and economics correspondent, Paul Castle, who's got all the details.
This is a process that happens every 5 years. The companies put forward their business plans, what they'd like to invest and spend, what they'd like to charge customers, Ofwat marks their homework and comes up with a total amount they can spend and, crucially, how much bills can rise. And if you look historically, since privatisation back in 1989, we're 35 years into this experiment. Now, the only fully privatised water system in the world. After initial rises, bills have actually been pretty flat. The focus has been keeping bills down. These are adjusted prices for inflation. The last line there, we're paying less today in real terms than we were paying a decade ago, but that is changing, and how. Ofwat has said today that on average, bills will rise by 36% across the board. And that is because the companies say they want to double the amount they spend. £104 billion they say they'll spend over the next 5 years. They need to do that to address concerns about sewage, to upgrade the system for climate change and expanding population, and frankly, to do some of the basic things we expect of them better. Now, how much you actually pay will depend on where you get your water. There's no real competition in water. You can't switch in any way, so you're stuck with wherever you are. So whether you can see some prices here, it differs whether you're Anglian, Northumbrian, across the board. But what you can see here, the green line is what we're paying now. The purple line is what I've said we pay. All these bills are going up significantly, and all the companies actually asked for more than they were given. I'll pick out a couple because they're significant in different ways. 53% bill increase for Southern Water, which today can't even provide basic tap water, 60,000 people of its customers. They actually asked for 83%. That's going to go up to £640 on average from a little over 400. And I picked out Thames Water. They're actually 35%. That's just below the average bill increase. But this company is in deep, deep trouble. It's got nearly £20 billion worth of debt. It was in court this week trying to secure an emergency loan. And Ofwat actually said today that Thames has been fined £18 million for paying unlawful dividends. Nearly £200 million it passed up through the company's structure, and 150 of that will be clawed back. So that is a big blow to Thames, and its future is absolutely in doubt. It now at least knows what it can raise from customers. But it's not just customers who'll pay more. Companies will pay investors more for the money they put in, both in borrowing costs and in equity they put in. Ofwat's agreed that because the cost of borrowing water has risen, the risk associated with the sector, investors will actually take more money out, which people might find hard to stomach. But I'll try and explain why that is. This chart shows the cost of borrowing, the cost of yields on bonds issued by companies. Now, the purple line is the water industry. The white line is an index of other UK corporate debt. And if we go back to the early 2020s, we can see here the purple line is below the white line. Water is cheaper. There was a halo effect, as it's called, because water was dull, it was reliable, investors liked it. And while the general cost of borrowing rose, water was still cheaper. It's cheaper for the industry to borrow. But look what happens in the summer of last year when the full scale of Thames's problems come out. The lines cross over. Water suddenly is more expensive. And the contagion, it's not just Thames, the whole industry is paying me. That's now 0.8% more expensive for the water industry to borrow. So the uncomfortable fact is here, customers are paying more because as long as we have this privatised system in which private debt raised on the money markets is what pays for improvements, well, bills are going to have to go up to cover that. Now, the regulator says it will make sure that the companies deliver on their promises and that they can't take money out that they haven't earned in dividends and in salaries. But for customers across the board who are now looking at the first really significant increase in water bill in years, I think this will all be quite hard to stomach.
Paul Kelso there. Now, the US-based consortium, the Friedkin Group, has completed a takeover of Everton's football club. The deal gives them a majority stake in the club and has been approved by the Premier League and the Football Association. Let's speak to Simon Leaf about all of this. Very good afternoon to you, Simon. This is a deal that was worth, we believe, in excess of £400 million.
That's right. This is a particularly large deal. You know, Everton has been on the block for sale for some time now. There were a number of other interested parties that came along and tried to acquire the club. Probably most controversially, 777 partners, who were the last bidders to fail in this endeavour. And finally, this is the news that all Everton fans would have hoped for just before Christmas, a real early Christmas present for them.
Indeed it is, and it is also cementing America's control, it seems, of the Premier League. I think they now essentially own 10 of the Premier League clubs, is that right?
That's correct, yes. I mean, the magic number really is 14. As soon as you get to kind of 14 clubs being owned in a certain way or voting in a certain way, that's when you really have the power to kind of change the Premier League's rule book itself. And so we're edging ever closer to that kind of magic number of 14. As you mentioned, Everton now the 10th club to have US owners, and I suspect that trend will continue going forwards.
And Simon, what are American business people thinking here? What are they hoping to achieve? I mean, we're not suggesting this is a concerted effort by, a coordinated effort, if you like, but clearly there's a lot of American interest now in the Premier League. What do they see this as? Is this a long-term business investment? Is this something they want to see boost, particularly in the United States, where football just still isn't as big as it is elsewhere? Or is this just a trophy asset that some Americans like owning?
Yeah, I mean, in many ways, it could be a combination of all of the above, really. In terms of the ownership of clubs in the Premier League in particular, the Premier League is still seen as very much a kind of trophy asset. And from a business sense, there clearly is a feeling that certain clubs are undervalued, and there's opportunities to grow the fan base, to grow the revenues, to look for kind of new revenues and new fans. So, ultimately from a business perspective, that's got to be the attraction. The other attraction that is often the case, and we're seeing amongst our own clients, is this move towards a kind of multi-club ownership model where you get one owner owning several clubs, across the world, and it's the ability to, share in economies of scale and get the benefits from owning, multiple clubs in different places. That's not without its own kind of problems, particularly when it comes to clubs that are within the same confederation. So particularly where you've got two clubs owned by the same owners that are potentially competing in European competitions. That's something that has caused UEFA a significant headache over the last few years. And again, it's a trend that we continue to see, and I suspect it will continue to go in that direction.
And
go on.
Yeah, I was going to say, just finally on this, though, one thing we have noticed is a bit of a British fight back at Manchester United.
Well, indeed, British of sorts. Obviously, Sir Jim Ratcliffe, resident outside of the UK, but we've heard today that Sir Jim has put more money into the club at Manchester United. We suspect this is to go towards the financing of the club itself, rather than money that will be made available in the January transfer window. But it's again a very interesting development. It shows that there still is an appetite for investors to put money into clubs. There's been a lot of kind of scaremongering in recent times, particularly with the independent regulator on the horizon, and how that may have an impact on the value of our clubs, and whether those from overseas will still want to invest when we're seeing a climate of additional regulation and obviously dispute, as we've seen with Manchester City and the Premier League. But for now, the league looks to be in good health.
OK, Simon, really appreciate your time this afternoon. Simon Leaf there from Mishcon de Ria. Thank you very much indeed. I think we're going to take you to a police press conference that's taking place in Bristol following the sentencing today. Let's go live to what, indeed, the family, I think, are having to say in reaction to this.
Their lengthy sentences. No sentence will ever be enough. Or as long as the 2 whole life sentences that these juveniles and 1 adult inflicted on both Mason and Max's families. No family should ever have to go through what our 2 families have gone through. These juveniles have not only destroyed our families, but to an extent their own lives and that of their own families. And we hope that as they grow older and mature, hopefully in prison, they do fully come to realise the extent of what they have done on that evening of Saturday the 27th of January. And they have to live with that for the rest of their lives. Mason was and will always be a massive part of our family. He was just a normal 15-year-old boy who loved spending time with family, friends, playing on his computer games and watching his beloved Liverpool FC. And it's so hard to accept that Mason and Max were taken from us all just for walking to the shops to get some food. We would like to thank Gary Haskins and his team, our family liaison officers, all the Crown Prosecution Service, including Stella and Ray Tully, also the jurors, and also the community, local and nationwide, that have done so much to help both of our families. Thank you.
There you go. That was David Knight speaking. That is Mason Rist's uncle, who, of course, very tragically was murdered. And we know that 4 teenagers who murdered 2 boys in Bristol in a case of mistaken identity have been detained for life, and that was a reaction there of one of them's uncles. We also heard a little bit earlier from the police in that case, and we'll bring you more of what happened at Bristol Crown Court with Mark Austin on the News Hour from 5 o'clock, but clearly a very distressed family outside Bristol Crown Court this afternoon. OK, let's bring you up to date now with what's happening in the market on this Thursday afternoon as we head into Christmas. Let's speak to Lindsey James, investment strategist at Quilter Investments. Lindsey, very good afternoon to you. Let's just talk about what's happening in the United States, because it's been a bit of a roller coaster ride over there, given what's happened in the last couple of days. Talk us through it.
Yes, that's right. Well, we had a little bit of a surprise from the Federal Reserve last night. So they were looking at interest rates for the year ahead, and they actually signalled that there would only be potentially 2 rate cuts coming up in 2025, where at their previous meeting they'd been talking about 4. And the market, to be honest, was expecting at least 3. So there was quite a lot of disappointment, even though they did cut rates by 1/4 point at this meeting. And we saw the market selling off quite significantly as a result of that. The S&P down nearly 3% as a reaction. And we also saw bigger falls from the Magnificent 7 stocks, things like Amazon, Microsoft, a part of that, and also from the small cap index. And I think some of the weakness that we've got in the FTSE today is reflecting moves last night from America.
And what is this? Is this kind of pre-Christmas jitters? What's the underlying currents here?
Well, it's really concerns that we're going to have a resurgence in inflation in the year ahead. So Jerome Powell said that from here on, it's a new phase. So they're going to be more cautious about rate cuts. Now, he didn't specifically say this was about Donald Trump's tariffs, but he did allude to this being a risk. And he also said that the voting members of the Fed can reach their own conclusions about the impact of tariffs on inflation. And it looks like from the dot plot, which is the forecast of where interest rates will end up over the coming couple of years, it looks like those tariff risks are starting to make themselves felt in those figures. So it's really about the underlying stubbornness of inflation and the fact that there are ongoing risks to inflation picking up in the coming 12 months.
And just talk us through what's been really interesting this week is that we've had 3 big interest rates decisions from the ECB in Europe. We've had, obviously, the Bank of England here and the Feds. And in many ways, they're kind of taking different approaches because our economies are in very different places at the moment.
Yes, that's right. I think the ECB have probably got the easiest job. You know, on the one hand, very weak growth in Europe and risks to that in the year ahead, but they look like they have largely beaten inflation, picked up a little bit in the most recent months, but that's primarily due to base effects. So it looks like they can start to cut without being too concerned about that inflationary picture. However, in the UK and the US, very different picture. Now, in the UK, we've had a problem with wage inflation. I mean, we might think that's a nice problem to have if our wages go up. But the problem is here, it's quite inflationary, and that's because we have very low productivity. In the US, they have a similar level of wage inflation, and that means they actually have a similar level of CPI to the UK. But because they have much higher productivity, that also means that the supply side of the economy is boosted. And so you don't get the same level of inflation feeding through as a result of that wage inflation. So it's a bit of a problem for the UK in particular, and that's something that they're going to be particularly focused on in the coming 12 months, particularly thinking about the impact of the national insurance hikes and how employers are going to react to that.
OK, great stuff, as always. Thank you very much indeed for joining us this afternoon with the latest on the markets there. Thank you. OK, just before we go, we're going to bring it to date with the rest of the day's business stories that are important to us today, and that is that the Spanish state-held shipbuilder Navantia has agreed to buy the shipyard Harland & Wolff in Belfast. The company, of course, best known for building the Titanic. The government says the deal, which is subject to regulatory approval, would secure all 4 of the firm's shipyards and protect around 1,000 jobs. Lenders have been told by the city watchdog that they have until December next year to respond to borrowers complaining about car finance deals with hidden commission payments. The Financial Conduct Authority's move follows a court ruling that it was unlawful for car dealers to receive commission of finance from lenders without customers' informed consent. And the government has admitted it does not know how much HS2 will ultimately cost or when high-speed trains will be running on the beleaguered rail project. The top civil servant at the Department for Transport has told MPs that the official estimates are between 54 and 66 billion pounds for the London to Birmingham leg are not reliable. And of course, you can get more on all this on our Money blog. Just scan the QR code on your screen now. OK, that's it from me on Business Live. I'm back tomorrow with a special festive edition at 11:30. Don't miss that. Up next, it's Mark Austin and the News Hour. Goodbye.